Hello, everybody. Welcome to today's webinar. Uh, Thank you for joining us today. We are going to wait just a few minutes to get started as we allow other people to join us. But just hold tight. We've got a lot to cover today. It's going to be, I think, pretty exciting for everything that insurance can be. But just hold tight for 1 second, and we will be up and ready to go. Thank you. Okay, well, I hope everyone has enjoyed that music as we are preparing to get started here. Um, Seeing we have a number of people joining us, I'm wondering as we're about to begin if anyone who has had insurance before, any kind of crop insurance from USDA, if you can send a text and let us know. Anyone who's had that, I think that would be very helpful. And also what you might hope to gain from today's webinar. I want to make sure that we get all your questions answered. As I said, we have a lot to cover. There's a lot to talk about with Micro Farm. It may be new to many of you, but don't hesitate to ask questions as we go and put them in there. And I'm going to start off in just a second by showing you a nice a 5-minute video that has a good background on what microfarm is, and it's a nice short presentation that'll give us a lot to jump off from after that. But want to hold off on 1 second to make sure we have enough people joining us before I hit play on that. Okay. Oh, good, good. I think we are about ready. So now let me add our video here. Um,
Hello, and welcome to our first training video on the USDA Micro Farm Insurance Program offered through the Risk Management Agency. Today we'll be discussing the basics of this new revenue-based insurance program. With us, we have Kevin, our resident micro farm expert. He's going to help us understand micro farm and how it can benefit farmers. So without further ado, let's get started. Kevin, can you tell us what micro farm insurance is?
Thanks, Kate. Micro Farm is a new program that provides insurance coverage based on your farm's revenue history. This means that the program looks at your last 3 to 5 years of farm revenue to estimate what you might earn this year based on what you intend to plant. That estimate is called your approved revenue.
Got it. Let's say my approved revenue for this year is $40,000. What would my premium be?
You get to decide how much of that revenue you want to protect. You can elect to cover anywhere from 50 to 85% of your approved revenue. So, Kate, if your approved revenue is set for $40,000, then you can choose to protect anywhere from $20,000 to $34,000 of your revenue. The exact cost of your premium will depend on the coverage level you choose. So, the higher your coverage level, the higher your premium will be, but the good thing is that this program is designed to help small farms succeed. So every policy issued is subsidized in part by the government.
Thanks, Kevin. But I'm curious. Does it matter how many acres I plant? Or what crops I grow?
There is no acreage limit for Micro Farm. You can also grow as many varieties or as few as you want. You can raise livestock or even produce value-added goods. That can include market readiness and post-production activities, such as canning, freezing, and processing. The inventories used in those types of activities can also be insured under Micro Farm, so long as the things you are selling are real agricultural commodities. However, Micro Farm does not cover some commodities, such as timber, forest products, animals for show or sport, or items such as bottled water or souvenirs that you may sell at the market. None of those type items can be included to build your revenue history or for revenue protection in your policy. You can still sell them on the farm, you just can't insure them with Micro Farm insurance. Also, one primary condition for eligibility is that your annual revenue does not exceed $350,000 for a new customer.
That's not a problem for me. But how does Micro Farm actually protect my revenue?
Micro Farm protects your revenue against potential losses due to various risks, such as adverse weather conditions, natural disasters, and market fluctuations. If your actual revenue falls below your insured revenue amount, you will receive what's called an indemnity payment to offset the shortfall. Let's look at Kate's farm as an example. We know Kate has an approved revenue of $40,000. This year, Kate opted for an 85% coverage plan. So, Kate's insured revenue amount is $34,000. This year, Kate's farm experienced not one, but 2 floods that destroyed about half of her crops. Kate ended up the year with actual revenue of $19,000. With that kind of loss, Kate is definitely going to receive an indemnity payment. But how much will she receive? Let's subtract the actual revenue, $19,000, from the insured revenue amount, $34,000. So in this case, Kate should expect to receive an indemnity payment of $15,000.
That payment would definitely help. So, to recap, Micro Farm Insurance is a new flexible program designed to protect the typical amount of revenue you earn annually on your farm. The amount of coverage you're eligible for is based on your farm's revenue history. The program was actually created to help small diversified farms protect against losses from natural disasters and other risks. I think I'm starting to get it now. I've got a small farm, and I sell mostly at the farmer's market and directly to customers from my farm. This sounds like a type of program that could really help me. Kevin, thanks for explaining that to us.
No problem, Kate. It's important that farmers have access to insurance options that meet their unique needs. This program can be a valuable tool for managing risks and ensuring the long-term success of your farm.
Okay, thank you everybody for watching that. I hope that little video starts to make a little bit of sense about Micro Farm, what it is. I'd like to talk about this in a little more detail now, kind of go through this a little bit by bit. We have a lot of forms we want to show you today, so you understand the documentation behind Micro Farm, but also We want to just talk about the timeline for when to apply, what to do, all of that, and make sure you're comfortable with everything there. But all right, if you have questions again at any time, don't hesitate to hop in and ask them. Okay, so again, microfarm, this is a revenue-based insurance program. This is a different type of program for USDA. Other types of crop insurance programs generally look at your expenses. They look at your commodities. They look at other comparative values in the marketplace. What Microfarm specifically does is says, let's look at the revenue that you make typically on your farm and let's protect that. So what that means is you have to establish a revenue basis. And it's almost like establishing credit at a bank or for a credit card. So it's like a credit score, but it's kind of like you build up your approved revenue based upon your actual history of revenue. So in order to apply for microfarm, you need to have 3 to 5 years of revenue history that you can show, that you can demonstrate. That's going to become part of what you use in your application. We'll go over more of that in a little bit, but just wanted to make sure that we understand that that's one of the key things that differentiates microfarm from other types of insurance. So as we said before, let's see, your farm revenue history, 3 to 5 years. It gives you your current year estimate, and that's important to help establish your approved revenue. So let's say, for example, as we talked about, the approved revenue is $40,000. What would a premium be? Wanted to make sure that everybody here understands that your premium, your coverage can be anywhere between 50 to 85% of your approved revenue. So once you go through the process of getting your approved revenue established based upon your farming history, then you can decide how much of that you want to cover. And that can be anywhere from 50 to 85%. So if your actual revenue is $40,000, that means you can select to cover anywhere from $20,000 to $34,000 of your revenue. And it's the 50 to 85%. And there are no distinctions as to how many acres you can farm or what crops you farm. This is intended to support small farmers who use diversified growing, so often selling for the marketplace. So that's what this is intended for. You might have 3 crops, you might have 15, you might have 18. You might grow livestock, you might have value-added product, you might have 2 acres, you might have 200 acres. Those facts are, it doesn't matter within microfarm. You're not going to be prohibited based upon any of those variations there. No acreage limit, no variety limit, livestock is acceptable, value add is acceptable as well. And we'll talk about those more in detail. But again, microfarm is about protecting revenue based on products that you produce, food products that you produce on your farm. So you can't buy bottled water and resell that or sell any other kinds of souvenirs or anything like that. You can't sell animals for sport. Those things, well, you can, but you just can't have those protected as revenue through microfarm insurance. This is intended to protect things that you actually grow on your farm. So again, the primary purpose of microfarm is to protect you from unavoidable natural causes such as tornadoes, wind damage, hail, early freeze, late freeze, drought, animal disease, things like this, and even market fluctuations that can occur. Those are not your markets directly. That's just to clarify that does not mean that anything that you are selling to somebody and they decide not to buy from you, it doesn't protect you in that way. What it does protect you from is if let's say there's a pandemic, or let's say there's a supply chain issue and the market has serious consequences and is not able to support the product the way it did, the revenue diminishes, or there's a complete inability to move the product in a more universal way that's not just about one particular farm, that is protected through those type of market fluctuations are protected within microfarm. So I'm going to change the view on this so it's a little easier to see that slide. All right, so we talked about a few different kinds of revenue within this. Allowable revenue is what is initially established. This says, all right, based upon your history, here's the type of revenue that would be allowed. Based upon looking back at 3 to 5 years of your growing history, we see that estimate. We kind of combine those together and say this is allowable revenue. Now, expected revenue is what comes from your farm plan for the year. You say, okay, that's what I did. This is what I'm planning to do this year. This is how many acres I'm planting. This is what I intend to grow. And this is the amount of revenue I expect to generate. So between those two, you need those two, and then they are put through a kind of algorithm, kind of calculation that helps determine an approved revenue for you. And it's actually part of that is the lesser of those two can help you arrive at what your approved revenue is. And that is something that your insurance provider will help establish with you and say, yeah, okay, based upon your history and your current expectations, this is the revenue we will approve for you. So you can earn and protect up to this much, or up to 50 to 85% of this much is what you can have covered, depending on which premium level you choose. All right, so, and that is your insured revenue. So let's say I make 100,000 and I choose to have 85% coverage, then $85,000 is my insured revenue. If I insure, have 50% coverage, then $50,000 is my insured revenue. So the actual revenue is the money I actually earn during the course of the year. That's what I actually make. And so it's the difference then between that actual revenue and that insured revenue. Your actual revenue is falling below your insured revenue, and the cause of that is related to natural causes that damage your crops, that damage your product, your ability to generate revenue. Then you'll be entitled to what's called an indemnity payment. All right, more on that later. Just reinforcing this right now. So we saw this slide during the video, and just to talk about that again. So approved revenue is 40,000 in this scenario. The farmer chose, Kate, our farmer here, chose 85% coverage. That means her insured revenue is $34,000. All right. So she had about 50% losses during her growing year. She had several losses. Let's assume that she had some hail damage. She had some frost. She had a little bit of drought at a different time. She was not having a good year. So she had about 50% losses that accrued from 3, maybe 4 different losses overall. So her actual revenue came in around $19,000. All right. So since she was insured for $34,000, her actual revenue is $19,000. Her indemnity amount then is $15,000. That's the difference. So that's then what she would get paid at the for her losses through Micro Farm Insurance. So she made 19. She's going to make another 15,000 back through insurance payments that will get her up to 34. Now, It's not going to get you up to 40. It's not going to get you up to what your approved revenue was, but it's not going to be a total loss either. This is the kind of thing that for a pretty good cost, when we start looking at your premium rates, can keep you in the farming business, and is you'll ultimately probably look at as just another good business cost that you have on your farm. So again, to recap, this is revenue-based insurance, relies on farm revenue history, protects against natural events, unanticipated, unexpected natural events. All right, so let's move on to another portion of this presentation right now, just to talk about your basic coverage. It's going to go a little deeper into a little bit of a deeper dive on some of this information now, and hold tight. The really exciting stuff is still to come. We're going to go through a timeline, and we're also going to go through some documents that we've also made available for you to download, because I know that you want to go home and you want to play with those documents and experiment with them just as much as I did putting them together. All right, so let's talk about coverage. Micro Farm protects your farm against the loss of farm revenue that you earn or expect to earn from all commodities on your farm except timber, forest products, and animals for sport, show, or pets. So yes, livestock, value-added commodities, and your crops, but it is commodities you produce during the insurance period, whether they are sold or not. It also helps protect you from commodities you buy for resale during the insurance period. So we'll come back to these parts later about maintaining your inventory and also accounts receivable, and those are part of the overall process, so that you can help track your revenue and what goes in what year, so that when you have losses, you can actually get paid. So with coverage, again, 50 to 85% is what your options are. It's the duration of the tax year. That's really the calendar year for most people, for most circumstances. So we'll come to this in a minute. You don't necessarily sign up for insurance until either February or March, depending on where you live. But the tax year actually starts at the beginning of the year. So you can begin producing prior to even applying for your insurance. Everything you do just has to be part of your farm operation plan, your intended farm operation plan at that time. Some people don't use a calendar year. They use a different tax schedule, and Micro Farm does accommodate for that. We're not going to go into that right now. It doesn't apply to a whole lot of people, but for those it does, just know that there are exceptions for you, and there's a way to manage that. Okay, so Micro Farm is available in all 50 states, and it's available for any farm with $350,000 revenue cap. So any farm making below $350,000 is good to go, provided that you've also done a few other requirements, but that's your revenue eligibility. If you're a returning micro farm producer, if you had coverage in the previous year, you can make up to $450,000. But initially, it's a $350,000 revenue. And there are other options. There's whole farm revenue protection instead of micro farm if you're making more than $350,000. So some of the things that you need. This slide right here talks about your crop insurance agent. That's with Risk Management Agency. And the AIP determine the farm's approved revenue using the following information. All right, your AIP. This is your approved insurance provider. Okay, so approved insurance providers are working around the country and every state, and they are the ones you actually deal with. You don't actually work directly through Risk Management Agency and USDA. You contact them initially, and they'll help point you in the right direction, make sure you understand what your timelines are, your deadlines for your state. But you will then find, they'll help you. They'll help you understand who you can connect with, and then you have to actually follow up and connect with an insurance provider, with an AIP, and they will provide you with their application and their version of forms. Now, what goes into the forms is mostly the same, depending on because it all is pulling from the same federal regulations. There may be some variations. They may ask for a thing or two different, and everybody's going to style it differently. But we have our own version of those forms, which we'll share with you here in a few minutes, so that you can be prepared and ready if you want to apply for microfarm. So some of those forms that you're going to need to create with the help of your AIP include your whole farm history report and your farm operation report. Again, we're going to go into those in a little more detail in a minute, but the whole farm history report is basically represents your revenue for the last 3 to 5 years. We say 3 to 5 years because you can use up to 5 years of records. Microfarm is different from some other policies in that you only need 3 years of revenue history in order to apply, but you do need 3 years. So there's a question. People often say, well, I'm a beginning farmer and rancher. Can I apply? It's my first year farming. Can I apply? Well, if this is your first year farming, then no. Microfarm is not something you can apply for this year. However, it is something you can start planning for, so that after you've had 3 years of farm record development, of farm revenue, and filing taxes on that revenue, you will then become eligible to apply. So that's something that you want to keep in mind. You only need 3 years, but they only look at 5 years of total revenue. But if you are a beginning farmer and rancher, you can get a premium subsidy of up to 10% if you are a beginning farmer rancher, which means you have farmed for fewer than 10 years. But you still have to have 3 years under the belt in order to apply for microfarm. Okay, so again, we talked about what it protects you from. What are you covered from? Natural causes such as adverse weather, flood, frost, heat, drought. Okay, so these days we have a lot more uncertainty with our weather. There's a lot of stuff going on that is going to impact both drought and heavy rains and heavy winds at different times, and even fires that can damage your crops. So this is a good time to actually think about investing in insurance. Microfarm protects you from all of those things. And if there's issues on irrigation, however, we'll come back to that in a bit as well. You do have to maintain good farming practices along the way. We'll pull up a slide for this in a little bit and talk about good farming practices, which are different from good agricultural practices or GAP. That's about food safety. Good farming practices are generally production standards that you should adhere to on your farm for the sake of quality. And those are pretty much expected of you to have good farming practices during this process. For example, if you just don't irrigate your product at all, you don't manage it, you don't fertilize it, you're going to have a hard time filing for a claim in saying that it was a natural disaster or natural cause, unanticipated natural cause, when it's something that you could have in fact controlled. However, there are other things like somebody asked a question in a previous webinar about wild boar, and wild boar is a natural cause. You are protected against damage due to wild boar coming in and perhaps killing your livestock, or even coming in and destroying your crops, eating all of your crops up. We're getting a question there. Is there a resource to review for good farming practice, such as spacing of plants, termination dates, and ways of termination? We're actually going to go into a separate video, not here, talk more about good farming practices. We'll show you a slide about that in just a minute as well. And it does vary. I think you can get really, really detailed about what good farming practices require. But in general, I'll just go ahead and pull that slide up. I already have it here. Good farming practices. Let me share this screen with you. Okay. Share screen. Okay, so good farming practices right here. This is what we're really talking about with good farming practices. You can do more than this, but essentially conduct a soil test for your growing areas and follow the recommendations for lime and NPK. If you do that, if you conduct a soil test, you have that test, you follow those recommendations, you document what you're doing. Yes, this said lime, and I limed. This is how much I did. I managed my pH. We did our nitrogen when we were supposed to. Yeah, everything is good. I have my records for when I fertilized. Those things are really important. So follow the written labels and instructions for all your farm inputs, for your seeds, your chemicals, your amendments. Follow your labels. Do the things that it says to do there. Or if you make an adjustment, you do something different, make sure that you document why. It can still be okay, but you just need to document why, what source is able to validate that change. Okay. So this is probably one of the most important and maybe even one of the most difficult or challenging things. You need to know how much irrigation water your crop needs. And so you need to apply the right amount, track rainfall, and apply irrigation accordingly. And this is something that you can get from Extension. It's pretty readily available just for that specific crop. You get a good idea. And I'm not saying you have to measure it to the exact inch in order to be doing good farming practices, but you need to know relatively what that crop needs for water and that you are applying it. That way, let's say you were applying it all along, you're doing the right thing, and then at the end of the season, you get massive rainstorms that come in and they end up, creating disease in your crop, or they end up stressing it out. In those instances, then you would have loss because of it. So going through there and doing the right irrigation and documenting it as you go, it creates real value for you. When it comes to when you plant, make sure that you're using some historical precedent for your area, so that early and late freezes aren't really, you're not going outside the boundary of that. You're not coming in and planting tomatoes in January and then saying, oh, well, they froze. That must be because of nature. That's not gonna fly. You need to plant the crops at the appropriate time. And then if there is a late freeze, then that would be a loss. If that causes damage or ruins those crops, that would be an eligible loss. So you just want to use some good sense with that and follow just your basic precedents and practices. Okay, so This is something that's a little different, but it's a really important thing to note here. Make sure that you apply practices and standards as required for any certifications you maintain or local and state federal regulations that apply to your operation. If any deviation from those practices and standards may impact your revenue. Okay, so what does that mean? Let's break that down. What that really means is if you are, let's say you are you're GAP certified and your buyer only accepts GAP certified product, and that's been your history. You know this for a long time, and that's part of what you've done to build up that revenue in the past. You have consistently sold to the same buyer who is expecting those or demands those good agricultural practices for food safety, right? And then let's say you don't deliver. You fail on your food safety audit. You lose your certification during the year. You no longer have GAP, and that buyer won't buy from you because of that. Could be the same thing with organic. You've got an organic market. You fail to provide your the proper documentation or proper practices for organic, and you lose certification in that. If you're certified organic and your certified organic buyer refuses to buy from you, if those things happen, those are not insurable events, insurable causes of loss. Those are really practices and standards that you have taken on in order to create your revenue. So the expectation is that you will continue with those practices and not refrain from doing them, or neglect them in any way that will end up damaging your revenue. So that loss is not protected. So if you are producing livestock or another non-crop commodity, just make sure you're checking with your local extension to do the things that you should do in terms of vaccinating your animals and keeping them safe and keeping on standard feed schedules and having them sheltered where they need. You do those types of things for the types of animals, for the types of livestock, and you are doing good farming practices. If you begin to deviate from that, you do something that's wildly unexpected, then and you suffer loss because of that, or your buyer won't buy because of that, then that's not going to be an insurable event. All right, so lastly, this is again very important. Document your activities. Just document them. Remember, if you didn't write it down, it didn't happen. That's the way it is when it comes to this, because the government actually has created Micro Farm, this insurance policy to support small farmers. If you have viable losses, real losses, verifiable losses, they want you to get paid. They don't want you to lose your farm. They want you to continue farming. They want you to succeed. That's why this program exists. But they also don't want people to take advantage of it and say, well, I didn't, I irrigated, if they really didn't, or I was fertilizing all the time if I really didn't, or I sold $400,000 of product last year if they actually didn't, if they actually sold 30,000 and they don't have sales receipts to back it up and they're just saying it. So this just comes back to this whole concept of documentation. Make sure that you are documenting the things that you are saying that you're doing. Okay, with that in mind, I'm gonna jump over here and I am going to show you a presentation of a timeline. I think this will be a little shift, and you guys may like this. Maybe not, but I hope you do. Let's see, wrong slide here and here. Okay, so let's look at the timeline for Micro Farm. Okay, I'm gonna zoom in here a little bit. All All right, so looking at the timeline for this is what we call our micro farm timeline cycle. Okay, and for this purpose, let's assume that you're going to be a new applicant for micro farm, and this is year one. All right, so where do you start? Well, let's start at the beginning of the calendar year for which you will apply. As you can see on this timeline, the application deadline comes at the end of February. We call this deadline the sales closing date, sometimes called just the SCD. About half the states in the country have a sales closing date near the end of March, as opposed to February. You'll just need to check with your local risk management agency to find out what your local deadline is. Okay, so you're at the application deadline. What do you need to do? Well, by this point, you must have identified an approved insurance provider. Again, we refer to that as the AIP. All right, so the AIP is just what it sounds, and like an insurance provider approved by USDA to offer you micro farm insurance in your state. The AIP will handle your application, your policy, any claims for losses you may have during the year. Again, you don't work directly with USDA for the management of your policy. So it's important that you don't wait until the day of the sales closing date to start looking for an AIP. Don't do that. You should make sure you identify your insurance company as early in the year as possible, and not wait until the deadline to apply. Because once you meet with your AIP, they're going to have their own version of forms for you to fill out so that they can qualify you for the program. So let's do everything we can to prepare you before you walk in that door. All right. So the forms that the AIP need include a general application, 3 to 5 years of Schedule F information. That's what we talked about, in the revenue history here, and all the information required from you to complete an intended farm operation report, that intended FOR. All right, so that's what's needed. And in case you didn't have a Schedule F tax form filed yet for the previous year, the AIP and USDA will accept what's known as a substitute Schedule F. And this is essentially the same as a Schedule F, but it's not an official tax document. And I'll share a substitute Schedule F form with you in a moment. It must contain exactly the information that you will file with the IRS. And it's also important to note here that all revenue you include on your Schedule F or substitute Schedule F, you'd have to be able to back that up with actual sales receipts or other appropriate documentation. Since microfarm is revenue based, again, the AIP reserves the right to verify your revenue, but you must still submit a substitute Schedule F for any of your previous tax years, so long as you can verify that revenue. All right, so we've established that you are going to need documentation of your revenue history prior to meeting with your AIP. The AIP will take all that information and use it to fill out your whole farm history report. We'll look at that form in just a second. The AIP needs the information in that report so they can generate your historic average revenue. That revenue is part of what is used to generate the premium cost for your insurance policy. All right, so that's important. That's why we need that revenue history, or that's why they need that revenue history. Your AIP needs another critical piece of insight to generate your premium, and that comes from the details you provide about your intended farm operation report, your intended farm production for the current year. All right, you need to know what you're going to produce and how much of it you intend to, and also where you're going to produce it. Whether that's acreage or acreage per crop or head of livestock or items or pounds of value-added goods, you need to put that into a production worksheet we'll share with you in a minute, so that your AIP can help you complete this intended farm operation report, which is fairly straightforward when you see it. But the report is mandated by USDA to help calculate your expected revenue. What you intend to make, your expected revenue is what you intend to make for the current year. So just like with the historic average revenue, your current year's expected revenue is needed to help generate your premium cost. All right. Also note that you'll need to have a USDA registered farm number. So you need to get that through Farm Service Agency, FSA. And you'll need to have a farm map, right? The map doesn't need to be professionally generated. You don't need to be a cartographer to create it. It just needs to show the layout of your land and where you intend to plant which crops, if you're doing crop production. Okay. All right. That sounds like a lot to do up front for your application. But once all that's done, well, you can get back to the hard work of farming. And you'll see that as the year progresses, and you're planting, harvesting, selling your crops, or selling your livestock and goods, make sure to keep track of your sales records, your sales receipts, your farm records. Make sure you're keeping track of those things, all your production records. And you may experience one or more losses to your farm at any time due to unanticipated natural causes. You'll need to keep track of these events and file what's called a notice of loss. So you have hailstorm, you have drought, you have tornado, you have anything like that. So within 72 hours of experiencing damage, you need to notify your AIP. They'll have a form for you. Each insurance company has its own form, but in general, you need to take pictures of the damage, describe the cause of the damage, and write a short summary of what was damaged and the extent of it. The AIP does reserve the right to come and inspect the damage. They don't always do that, but they do reserve the right to do it. So because they reserve that right, you need to communicate clearly with your AIP before you destroy any lost crops or goods. All right. All right. So let's continue through the microfarm timeline cycle. We're working here. We're going through. As we come to July, you'll see that we have an acreage report due. All right. So an acreage report is that's just a revised farm operating report. All right. So the revised FOR. In this case, you put any updates from what you intended to plant versus or tended to produce, what you actually produce. Sometime between February and July, things change. You may have intended to plant 8 acres, but you only ended up planting 6, or you may have gotten a little crazy out there and planted 10. Either way, you need to adjust your farm operation report around July. There's some variation around the country as to when that's due as well, but just assume it's about this time. So any contract changes that you might make would come around August. So again, the dates slightly differ depending on where you are in the country. All right, from this point, you'll continue. By the way, I forgot to mention this. In August, that's when your premium is actually due. So you don't pay your premium until after you say, all right, I intended to plant all this. I actually planted this. So that changes. It possibly changes your expected revenue for the year, right? Your historic revenue is not changing, but your historic average revenue is not changing, but your expected revenue for this year may change, and that can impact your premium. So that's why you don't actually pay your premium until August. That's right. You started work back in January, and you may have even started work back in November on planting crops, or maybe you were planting strawberries or something like that for production for this year. That would still be counted as revenue in this year's production. Okay. So that's part of this year, but you're still not paying your premium until August. All right. so let's continue on through here. So continue to collect your sales receipts, your farm records, your notice of losses all throughout the year as they may happen. And then, we're keeping working. We're all very, very busy here. Then we get to the end of the year. All right. So what happens at the end of the year? Well, now we need to prepare for the beginning of your second year of microfarm. Can't believe it went by that fast, but it did. So you'll have what's called, if you're a returnee, you'll have what's called a carryover policy. All right, first things first, you'll need to complete your final farm operation report. Yes, there's another one. So you had an intended, revised, and now a final. Basically, that all that means for completing your final farm operation report is summing up what revenue you actually made by the end of the year. All right. So this is where you go through and you say qualified revenue, that's eligible for calculation within microfarm. And that includes, going back and looking at your inventories, separating out what was from last year's inventory, versus this year's, everything that was produced here, accounting for accounts receivable as well, things that you may have gotten paid for last year, or things that you may not have gotten paid for this year. All of that impacts your revenue and ends up going into your final farm operating report. Now, it's critical that you have to file that farm operating report before you can file your indemnity claim. You also have to file your taxes before you can file an indemnity claim. All right. So your indemnity claim is basically where you go back through the year, you look at all your losses. So you have those notice of losses that you've documented, and then you say, hey, this is the revenue. This is my improved revenue. This is my insured revenue right here, what I expected to make. This is what my actual revenue is. So here's that difference right here. So that's what you can expect in terms of filing an indemnity claim. So you're highlighting that difference, right? So you just need to make sure that you have the rest of the documentation in place to support it. All right. So you can wait to file your taxes, later, and you could file your taxes in March when they're due, but you can't file your indemnity claim until after you file your taxes. All right. So that's gonna be a little bit of an issue. So this is, again, important to just make this distinction. You get an indemnity payment, right, for your losses in the following year. So I'm working in 2023. We had these, losses that happened on the farm. So I still have to finish my farm operation report. I have to file my taxes, and then I can file my indemnity claim. Within 60 days of filing my taxes, I have to file my indemnity claim. And then from that, once I do that, the IRS will pay me, or the government will pay me, the insurance company actually will pay me within 30 days of filing it. All right. So if you're waiting until March to file your taxes, or April to file your taxes, then you may be waiting a good deal longer to file that indemnity claim. All right. And it may be a good deal longer than that before you get paid. You may be looking at, if you max that out, you may be looking at another 90 days after, the middle of April before you get paid. So filing your taxes early has some benefits. All right. So you also have to file your final farm operating report before you can apply for the next year's policy. So you can't re-up that insurance, until you file your final farm operating report for the previous year. So you got to get that done before that sales closing date. Again, we talked about this before. That sales closing date could be in February, could be in March, depending on where you're located in the country. But that's the idea. You have to get that done. And with this, just as the year before, by that application deadline, by that sales closing date, you'll need to have your farm plan in place for the current year. That's right. You need to know what you're growing, generally how much of it, and where. Now, this may be a good time to state this. This is really interesting on Micro Farm. You don't need to identify how much revenue you're making with each crop. All right, so it simplifies things in that way. They're only concerned with what's your overall revenue on your farm. All right, so you just have to say how much acreage you intend. Half an acre of squash, an acre of peppers, and a quarter acre of tomatoes. Those are the kinds of things that you put into your production plan, and they all get bundled up and say Micro Farm is then making, and then it's got what we say 1.5 and a quarter, so 1.75 acres of total production for Micro Farm this year. All right, and your revenue is based upon all of that put together. So I hope that makes sense. So let's exit out of there. And that. All right. Okay. So I'm going to ask if there are any more questions right now before we move on to some different topics. I will come back here, finish the slide. You guys keep asking questions if you have them. Following up on this about eligibility, you have to be eligible to receive federal benefits. It also means that you have to have a farm number. If you haven't set that up, then you're not going to be able to get paid for any indemnity claim that you may receive. So that's important. So you have to go again through FSA before you go to RMA and make sure that you've got a farm number in place. You have to be a U.S. citizen or resident. You have to file either a Schedule F or a substitute Schedule F that you can make based upon other documents that you filed. Have to have less than $350,000 of approved revenue, and no more than 50% of the revenue can come from commodities purchased for resale. So that's like I'm making a certain value-add product, pickling something or making something else. The ingredients for that, I can't have more than 50% of the ingredients come from outside of my farm. I've got to generate and create those things here myself. Okay, so this is everything that's required on a federal level. However, there may be other stipulations that your AIP, your approved insurance provider, have that relate specifically to things like have you had a recent bankruptcy, or did you not file did you file a faulty insurance claim in the past or abandon an insurance program? They may have questions about that. I can't speak for them, but those are questions that you might need to have an answer for when you come in and talk to your AIP. Now, again, I wouldn't, if you're doing these things, you're following this as we're talking about today, going through this, and you're documenting everything as you go. This is something that's here to help you. I wouldn't be overly worried about those things, but do make sure that you're doing your good farming practices and doing the things that you should. Okay, I'm going to, again, let's see, share my screen with you over here. I think, there we go. So this is, what I'm showing with you now are some of the forms that you need. And that's not very easy to see right there. So I'm going to zoom in on that a little bit more here, make that a little easier to see. All right. So these are some of the key forms that you need overall, that either a Schedule F or a substitute Schedule F. I'm going to walk you through that. So an allowable revenue worksheet. All right, so this is something that you can do this with your accountant if you have one, or we can show you how to work through that here. Your AIP may be able to help you with that as well. But it basically says, all right, there's some things that you do. Your Schedule F form is what you use to document your farm income, and it can come from a variety of things. But there are some things that aren't allowed, and your allowable revenue worksheet helps make those exclusions so that just the revenue that is allowable passes through, right? So we'll look at the production worksheet, your whole farm history report, the historic production worksheet, which is very brief, but we'll show you that as well, farm operation report, and those are the things that are really about applying. And then during the year, there's the daily marketing sales record, accounts receivable, inventory report, and market animal and nursery inventory report. All right. So we're going to look briefly at those items. We won't go in too much depth about it because we could actually spend an entire webinar just on a couple of those documents. But I do want to let you know that this document is available for download on the Up and Farms website. So if you go to www.upandfarms.com, and I'm putting that in the chat right now, and you go to the download section in that, you'll be able to see that this document is downloadable along with some other documents that may help you. Okay, so let's start by looking at the substitute Schedule F and what this is. Basically, this is just, it looks like a tax form because it essentially is a tax form. It's exactly what you would see on a tax form. All of your information about how you make revenue from your taxes. How you make revenue from your farm and the different tax categories for that. We do have a separate video that we're going to release. Again, we'll put that on the Up and Farms website, and we've already recorded it. We're editing it now. It should be a couple of weeks, and we'll have that available. So that we'll talk through both the Schedule F, right, and then also the allowable revenue worksheet, which follows the Schedule F. This is the one where we look at line items in the Schedule F, right, such as sale of animal and other resale. It should be items, not interns or intoms right there. I don't know what an intom is, but it's not something that normally appears here. But minus the cost or other basis of such items. So that means that if you purchased something for resale, you subtract the cost of that resale item. You subtract the cost of purchase from it. And so that would be an adjustment that you end up making. So what gets passed on from your Schedule F, you make revenue adjustments here, and then this ends up with your allowable revenue. So let's say that we had $120,000 here, and we're going big. We're doing it. We're actually farming here, and we had an adjustment, let's say, of $20,000 here. All right, so that means that we'd have $100,000 passing through to build up our allowable revenue. Again, that allowable revenue is part of what's used to calculate our insurable revenue, what we're actually going to have insured. So sure, we want this to be as high of a number as possible, right? We want it, let's make it a really big number. However, your premiums do increase with that, but it does also mean that you can have more protection on your farm. All right, so let's look over here, sale of livestock. That might generally be, let's say or crops produced. This is where you put your crops produced. Let's say you had $60,000 in crops produced. You don't have any revenue adjustments, so that passes through. Cooperative distributions, that gets a little more complicated. We will talk about that specifically in our Schedule F and allowable revenue video. But essentially, there could be some cooperative distributions that may not count because they may not be directly related to your production of produce. Other kinds of dividends that you may receive from cooperatives. So if that's the case, then that would be an adjustment and that would be a subtraction from here. So you wouldn't be able to include that. There are other things, agricultural program payments, commodity credit corporation, loan payments, other things like that that are automatically excluded. So I just went ahead and blocked them out on this sheet. So you wouldn't do that. Custom hire, just for example, that means you were making work, you're making money. That would show up on your Schedule F. You were custom hiring yourself. You're using your skills, your machine work skills to help somebody else on their farm, and you're getting paid for it. Well, that's not allowable here. It's not allowable on at all as income, in micro farm because it's not directly related to you producing the product and the goods that create your revenue. All right. So that's automatically excluded. And so we get down to here, and then we have an allowable revenue for our current tax year. All right. So that's kind of the way that works. By the way, when you're on these sheets, you can always click on this once you've downloaded it to go to the Up and Farms website, or you can click on this little handy icon right here, handy icon, and you can go back to the table of contents. All right. Well, look at the, while we're here, let's go back in order. So we just looked at Schedule F, allowable revenue. Let's look at this production worksheet. All right. So this is not intended to be very complicated, but this is something that, you want to coordinate with your map. All right. So when you draw a map, you've got that, then you have identified your tract, field, and bed. Now you don't have to include bed. Maybe it's just a field. I've got a whole field of squash and that's it. No beds, or all the beds are that. So if that's the case, you delete the bed, and that's fine. The whole field. But you may have something else in tract one, and field 1 and bed 2. So you may need something in bed 1 if this is, say, let's say this is bell peppers. Okay, so you may have something like that. In practice, this is where you would select: is it irrigated, non-irrigated, or other? So again, this has impact on your revenue expectations within there. All right, so this is for this year. I'm saying my intended acres, we had 0.5 acres for that. Let's say we're going to do 4 acres of bell peppers. We're going to go crazy on bell peppers. All right, so I would come back to my production worksheet during the year and say my actual acres. This is when I do my farm operating report. My revised version of that, I come back and say, well, my actual acres were 2, all right? And the status of this, that's, let's say that is completed, and this one is still active. But I want to put a planting date in here as well. So let's say this was April 6th, 2023. So I have that in here too. The planting date, you'll end up referencing that at other times, especially, you need reference for your planting if you have damage or something like that. So it's good to go ahead and create a planting date within this. So you're actually taking all of this stuff, and we'll come back to your production worksheet in a second when we look at your farm operating report. But basically, when you come to your farm operating report, all right, this is your farm operation report. This is the big one that, again, we had intended, revised, and final. We're talking about that, and it sounds probably really scary when we're talking it through, but it's actually pretty straightforward. All right, this is your farm operation report. So all of those things from your production worksheet, if you're growing crops, all of this stuff, all right, here, everything that I'm doing. So I look at my total acres, right, and then my intended acres, right, 4.5. That's what I'm going for. Well, when I'm in my farm operation report, that's what is intended, right? 4.5. So that's where this would go for this year, 4.5. All right. So this basis comes from our historic production, which we'll come to back to in a second. But this is what your production is all added up here. For crop, you do something similar for livestock. Your method for crop is going to be acre. Your method for livestock could be different. It could be head or it could be pound. This could be each or it could be pound. There's some different options in there for you under method, but you just have your quantity of whatever that's going to be. And then your basis. So we multiply your quantity times your basis. That's your value per quantity. So our basis is, $5,497 per acre. We've got 7 acres in this scenario. So that's going to have an expected revenue of here. When we come back in our revised farm operating report, we said 8 acres, same basis. So we're expecting more revenue. So at the end of the year, when we come back and we do that final, the actual revenue, that final operating report, that's where that comes. And it's just one line here to complete your final farm operating report. It's just one line for each of your different commodity types, right? That go in there. All right, so let's come back to this basis. This is important. Basis. All right, what was that? What was that all about? How are we determining that? Well, let's look at your historic production worksheet, right? All that this means is we're going to look at the previous 3 years. We're looking at crop production here. The previous 3 years, 2020, 21, and 2022. This is what my revenue was for each of those years. Total revenue. We're not talking about individual crops. We're talking about my total revenue for each of these years. 2020 was 33,000. We did 7 acres. All right, and we can document that. We knew what it was. We had a map. We planned that out. All right, so we had 7 acres. So $33,000 in revenue, 7 acres. That average per acre is 4,714. We do the same thing for 2021, 7 acres. This time we made a little more, so our average is a little more per acre. Last year, not quite as much, 36,000, but we didn't do as many acres. So our average revenue per acre actually went up, and it was 6,000. So total over those 3 years, our average income, our average revenue was $36,667. $36,666 or 67. Yeah. Our acres produced are on average were 6.67, and the revenue per acre averaged out was 5,497. Right. So that number, 5,497, becomes our basis for this. So when we're talking about our intended revenue for this year, or even our revised revenue, that is the basis that we're using. That the only thing that would change is if we're saying, hey, 4.5 would I intend to grow this year, right? The basis stays the same, but my expected revenue will change depending upon how many acres I'm planning to plant. So that's the thing that will change in that. All right. So I hope that makes sense. Let me know, please, if that does not make sense or if you need to explain that a little further. But that's basically your farm operating report that is required. So between the production worksheet and the historic production worksheet, those two things, which I think are now pretty simple, that's the information you need to bring in to complete your farm operating report so that you can say, this is what I intend to grow right here. And then come back in July and say, this is what I actually grew. And then come back at the end of the year and say, and this is how much revenue I made. So if you see a difference in there, then that's going to, between these two items, that's going to show where your loss lies, right? And where you might be eligible for an indemnity payment. Okay, so let's come back to now our whole farm history report. This is where it gets really fun And I'm gonna spend a little time on this, but not too much. But I want to, because I want to be able to jump to the premiums to let you kind of get a feel for how much how much this program is going to cost you as well. All right. So basically, let's say that yeah, this is my current year expected revenue. 56,000, and I've been in production for 5 years. And well, let's take that out. Let's say I've been in production for 3 years. All right. So you see that I don't have anything over there. I didn't do anything in 2018. So I'm going to select did not farm. Didn't do anything in 2019. I'm going to select, did not farm. So that was 0 and 0. All right. So you see things started to change down here. All right. So this is what my current expected revenue. I'm going to increase that because I'm a bigger farmer. I have bigger numbers in here. So I'm going to say I'm going to make 142 this year. All right. That's what I'm planning to make. So I'm planning on increasing a little bit, even though I've been in production for 3 years. By the way, this is a really good farmer right here. These are really good numbers for, just starting out. But that's what I've got. So I'm able to, have a total from those, get a calculated simple average. And, we've decided, yes, let's use revenue substitution. I could say, no, don't use revenue substitution and take that out. And I could say, no, don't use revenue exclusion. I could take that out. That didn't pop out, but that might be a little problem, a little bug, but I got to fix that. But substitution is in here. Yes. So basically, these are things that could increase your revenue for you. To look at that whole farm historic average. There are things that let's see can impact that as well. What ends up happening is you take your lowest number and extrapolate that out to 5 in order to get that. If you don't have those 5 years in place, you've only got 3, they have to create the other 2 years for you so that your math works. So they're basically taking the lowest year and expanding that out or multiplying that times 0.6 in order to get that. But let's say that we've been working for 5 years. All right, let's say we have 5 years of production in place, and let's say we made 95,000 this year, and let's say we made 103,000 this year. All right, so now you see all those numbers change. And not only do they change, we're able to use indexing because we have 5 years of farming here. So basically, these are just some ways between indexing, substitution, exclusion. These are some questions that you'll be asked, and you'll just want to say by your AIP if you want to use those. And you say, well, yeah, if I'm eligible, of course I want to use those. I want to use whichever one is going to get me the best allowable revenue. So you would include all of those things, and then they factor in and they give you the best option. So in this instance, you end up with indexing selected, you end up with 126,000 as your whole farm historic average. If we were not eligible for indexing, if that was no, we didn't want to do it, for some reason, then this number is going to be lower. So if we deselected for indexing, it would default more toward the 117 over here would be our whole farm historic average. Okay, so this is in a nutshell how the whole farm history report helps you generate a whole farm historic average. Okay, and that whole farm historic average, right, along with your expected revenue, those are the two things that help determine your premium. Okay, let's go and let's look at that for a second. All right, so this is a little crazy here, this scenario, but I want to make sure that you see something like this. You have a chance to view this to understand basically what that premium might be. Let's see, did that update? That did not update. Let's go back to whole farm revenue, did not farm. Okay, so the need to update this. That's 2019, and this is 2018. All right, you see that in the scenario, it's using those dates. So basically, we're taking our whole farm historic average and our expected revenue for this year, and we see that our approved revenue for this year comes back at $126,000. So I can, for the sake of this premium, we're using this as a calculator, so we can just simulate some different options as well. But so we can enter the historic average, or we can decide to do it manually. And let's say we wanted to do it manually. So we want to ignore our historic average and say we're working with a smaller basis here of $80,000. Now I can come back in and say, let me use manual entry. Whoop, it's not going to, oh, yeah, I'm not going to do that. I have to change this. I apologize for that. I have to unprotect the worksheet in order to change that. Just assume you can do that, just as you can do expected revenue. That's right here. This is manual entry, but put in 146. We could use, we do that either. So I apologize for that. I would have to go into view and unprotect. I'm not gonna unprotect that right now. But let's just. I'll update this for later so that you can see that you can select to do manual or what comes in automatically. If you're doing that and you're choosing a beginning veteran subsidy, say yes. That's because you're either a veteran or you have a beginning farmer rancher status of farming less than 10 years. All right. So let's say what our earned revenue is. We're using some bigger numbers here. So let's say our earned revenue is right now is 82,000. And let's say some of those revenue adjustments because of inventory and other things that we had, let's say that it's 5,000. All right, from there. So that gives us a revenue to count of $87,000. Yeah, so yes, so we had inventory. And so when we made that adjustment, okay, it added to our revenue, even though it may not have been something that we sold, we have it in inventory. Or this may come from accounts receivable, right? So that it adds to this. So what it does is it says, even though we earned 82, actually on the books, it's 87. And that's what's getting us closer to our overall insured revenue. All right. So our indemnity payment is not going to be quite as high. Well, it's going to be what it's supposed to be, but that does affect what your indemnity payment is. All right. So, okay. Now the big thing. Let's come down here. Again, we are looking at approved revenue of $126,000 on that, and we're using Hinds County, Mississippi, as our basis right now. These county rates change. It's different for every county in the country based upon actuarial standards of where you are, how likely you are to have some kind of a natural occurrence. It's different from Florida than it is in California, than it is in South Dakota. Different events. So this is the rate for Mississippi, which is more or less right in the middle. And so what we've done here is we show you what this looks like for different coverage rates from 50% all the way up to 85%, all right, based upon, and you see that, there is change. As you go up through to 85%, the rate is going to be a little higher. That's 0.395 than 0.3438. So as you increase your coverage, that rate is going to go up a little bit too, all right? And we'll see how that plays out in just a second. So here's your liability, all right? So now we're looking at our county rate, what our approved revenue is times our coverage, which is 50%. So that's approved revenue is 126,000. We're saying our coverage is 50%, so our liability is going to be 63,000. All right. So as we go through, you look at the different coverage opportunities up to 85%. You see how the liability increases through here, and that means that your deductible decreases through this as well. As you go through, it's the inverse of your liability. So over here, your deductible is essentially at 85% coverage. Your deductible is essentially $18,900. All right, then we don't really need to worry about weighted county rate or premium rate about what these things are. These are just calculations, complicated calculations that are going on in the background. But what we do end up with is a base premium. And you can see, yeah, that's kind of expensive. For $126,000, 50% coverage, a base premium is $11,340. For 50%. At 85% is $22,170. Now that's a base premium. Fortunately, Micro Farm is highly subsidized by the federal government, so that's not actually what you pay. There's a subsidy factor that's built in, and there's that would be your Micro Farm subsidy. So instead of paying that $11,340, you have a $9,000 subsidy here, and that reduces your premium. You also have a 10% beginning farmer, rancher, veteran subsidy here, so that provides a total subsidy of $10,206. So at 50% coverage under that scenario for $126,000 of approved revenue, your final premium is $1,134. It's a little higher over here at 85% revenue. All right. So, and as you see, if this were to go down, these numbers would go down dramatically. So that you might be paying, $200 or $300 if your approved revenue is only $20,000 to $25,000 a year or $30,000 a year. So your rates could vary wildly. We'll say that when you look at these numbers, right, if you just look at your final premiums over here, this one, 75% is a pretty good number. That is a good rate in general. So when you're thinking about what coverage is right for me, I'm not an insurance person, but I can just say, looking at the numbers right here, there's a big jump between 75% and 80%, and between 80% and 85% coverage. 75, and there's not that big of a jump over here, but there is a big difference between 75% coverage and 50% coverage in terms of what you can recoup, right? So I would take a good hard look at 75% coverage as what I would want to be insured for. All right. So in this sense, we're saying we made $82,000 a year based on that scenario up there. We made 82. We had revenue adjustments of 5, if you can remember. So revenue to count of 87. So 87. All right. So we have no indemnity payments in this. But over here we do. The higher we go up, the higher the indemnity payments. Over here, at 85% coverage, is a $20,000 indemnity payment. $20,000 difference between your liability and your liability up here and your actual income, right? So your net insurance on that year in that scenario is $12,562. If we were to roll back over here to 75%, we would see that the net is $5,620. Over here at this rate, you're still out of pocket for your premium, what you paid. That starts to go down a little bit over here at 70%. right? It starts to even out a little bit, but you're not making money. Over here at 5,620, at 75%, that you end up making $5,600 more than you would have if you did not have the insurance. Even though you paid $1,800 out of pocket, you're still going to end up with an overall net of $5,600. Okay, and that's at the end of the presentation. It's at the end of our time for today for everything we were going to deliver. So at this point, I'm going to come back to our basic slides here and say through this process, we've been working very closely here in Mississippi with Deborah Shows with RMA. And this is her contact information on the screen right here if you'd like to reach out to her. If you have any other questions, I'm going to hang on here for another 10, 15 minutes or however long you need to answer questions. I've been talking a lot, we covered a whole lot of territory. Hopefully this answered most of the questions that you might have had, but if not, I'm here. So ask away. Otherwise, I really hope you enjoyed it. And if you did, let us know, let me know, and let us know also. Send me that email to david@upandfarms.com. Let me know what you enjoyed, what you didn't enjoy, what you'd like to hear more of or less of. There's a lot of information on this topic that we've uncovered, and we're more than happy to share everything with it that we know. Again, we will have additional videos coming out. We'll have another video that does do that timeline presentation. We'll have one that addresses the allowable revenue and the Schedule F, that worksheet. We'll have videos specifically on that. And you can also download these documents on our website. In addition to all of that, we are creating an application that you can link to from our website as well, that would allow you to come in and run your own premiums, run your own scenarios, upload your substitute Schedule F's numbers from that. So it's actually working with your numbers and give you this kind of output in real time based upon the actual county you live in. Can't really do that easily in Excel because when we got that information back from RMA, it was something like 17 million lines of data within it that, somehow, in the spreadsheet, that many different rows of information. We got that down to a few 100,000 and then eventually to like 70,000. But there's a lot of information for that to have all the actuarial info for every county. But we built an app to help you with that, so we can hopefully give you a better sense of what your actual premium will be. Again, I'll hang on here for just another minute. I'm going to put some music on. If you have questions, feel free to send them on in. Otherwise, we are done for the day, and I really appreciate your being here. Thank you. you.